In terms of the current portfolio positioning of this fund, we have been more inclined towards some of the domestic themes because we think that India growth is going to be fairly steady compared to the global growth. So with that logic, we are overweight in sectors like the industrials and the infrastructure sector, where we have seen the government focus on infrastructure has been driving good order book position for some of the companies over here. Also, the private sector capex is something which we believe is likely to pick up, considering that the corporate balance sheets are in good shape, banks are in good shape, and the capacity utilizations have gone up. So that should continue to drive stronger growth in the industrials and the capital goods sector. In the fund, we also overweight on the pharma sector, which is a kind of a defensive play. Again, here our larger weight is in the domestic pharma companies, where we see a structural growth of around 10 to 11% over there, and also in the healthcare sector, where we think that there is a big shift from the unorganized to organized, which will drive growth for the healthcare sector. Also on the export fronts, some of the export oriented companies, for the first time we are seeing that the US generic market is showing some amount of pricing stability, and which should help the exporters on the pharma side. Another sector which we are overweight is the telecom sector, which is been a kind of a steady compounder, and we have seen a consolidation in this sector, and we've seen a recent tariff hike, and we see more tariff hikes in this sector, okay, which will drive stable earnings growth. And also because the capex intensity has now reached its peak, you will see these companies generating a good cash flows. We are also positive on the auto and the auto and ancillary sector. Again, here, while the volume growth has been kind of steadily improving, but premiumization is a theme which is driving better ASP per vehicle, and that is driving the top line growth as well as the bottom line growth in this sector. Consumer discretionary is another area where we are positive and overweight. We think that India is at an inflection point with per capita GDP crossing $2,500, which will drive demand for consumer discretionary items in the retail sector, consumer durables, apparel, footwear, which will be a structural trend over the next decade or so. So we are positive on the consumer durables and the retail sectors, okay, where we have seen some of these companies have underperformed in the last year because the recovery in the consumption side was much slower. But with the rural economy now expected to do well, and with inflation coming down, we expect this sector to gain traction in the coming years. Apart from that, we have got some exposure in the aviation and in the hotel sector, which are the broad macro themes which are expected to do well. Our underweights are mostly in the global sectors like the oil and gas sector, where we don't see any major structural drivers. Refining margins are under pressure, and we see steady, not any exciting growth in that space. We are also been negative on or underweight on the IT sector for the better part of last year, but slowly we are correcting the underweight and increasing our weight in the IT sector, as we think that this sector has bottomed out. The earnings downgrade cycle in the IT sector is now behind us. The commentary from the large IT companies is suggesting to us that they are seeing some green shoots, and we should see the volume growth picking up. And structurally, we believe that the spends in IT globally are going to only move up despite the near-term concerns in terms of the US growth slowdown. So we will look to increase our exposure in the IT sector going forward. In line with the global slowdown which is expected, we are also underweight on the metal sector. We've seen that China, while it is trying to recover, but it's still not been able to really come to the pace, and that will mean that the overall demand for commodities, okay, will remain weak. Another large sector, which is the banking and financial services sector, which has got a large allocation in most of the funds. We are neutral in that space, but within the banking sector, over a period of time, we have really booked our gains, some gains in the PSU banks, which have done very well, and moved over private banks. Okay, we still believe that structurally private banks will continue to exhibit better growth over there. But within the whole financial services sector, we're more positive on the non-lending institutions like the insurance sector, where we have increased our weight. This sector went through a kind of a turmoil last year because of the regulatory headwinds what we have seen. We think that those things are behind us, and we see a steady compounding in this sector of around 15% in terms of the overall industry growth rate. At this juncture, we think that the broader market, right, lot of these sectoral themes, large outperformance what we saw in a few sectors have kind of played out, and we don't see any big risk reward in a particular area. So our sectoral bets, deviations have kind of narrowed down, okay, probably aligned more towards the benchmark. Also, this is the time, because of the sharp rally what we have seen in the market over the last couple of years, we've been trying to reduce risk in our portfolio. Stocks which have really rallied and gone above our comfort zone, we've been booking profits over there, and in a way try to consolidate the portfolio. Also, our mid cap, small cap exposure, we are trying to kind of a cap at around 11 to 12%, not try to increase at this point in time. And our approach is to really ensure that we don't take any large risk at this point in time, because the markets where there is a risk of some kind of undershoot on the downside because of global factors.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.